Today's topic is on mutual funds, how to achieve your goals and lead to your financial wellness. Now we begin with the basics. What are mutual funds? Mutual fund is actually a pool of money, managed by a professional fund manager. And it
I'm
is basic.
sorry, Mr. Nimish, can you be slightly louder?
Yeah, okay, sorry. Now is it okay?
Yes, much better.
Yeah. So I'll begin again. What are mutual funds? Basically, it's a pool of money managed by a professional fund manager. They collect the money from the number of investors, who are wanting to invest in the market, be it equities, bonds, money market instruments, or even other securities. Okay, so the fund manager collects the money from us, and whatever incomes or gains which he generates, from the investment is distributed proportionately amongst the investors after deducting all the applicable expenses. Okay, now this is done by calculating the scheme's NAV, or which is called as the net asset value. So here, when you see, in the blue circle, we are investors who pool in the money. The fund is professionally managed. They invest in the securities, and they are given it back to the investors by distributing the profits. Now, how do we make people understand? The simplest way to understand mutual funds is that let's say there's a box of 12 chocolates, which is costing 48 rupees. Now there are four friends who decide to buy the same, but they have only 12 rupees each, and the shopkeeper will only sell by the box. Now, so the friends then decide to pool in 12, each of them has 12 rupees. So they pool in that 12 rupees and they buy the box of chocolates. Now, based on their contribution, each of them would receive, three chocolates or three units if you consider in terms of mutual funds. So how do we calculate, the cost of one unit? So the whole box is costing 48 rupees. If we divide it by 12 chocolates, that means each chocolate is costing 4 rupees. So now each of the friends have contributed 12 rupees, so whereby each of them will get three units, that is three chocolates. So in this way, each of them will be the unit holder in the box of chocolates, okay, which is held by them, and they each become part owner. In the same way, mutual funds are something like that only. You invest in the units of the scheme based on your contribution, and you become a part holder of that mutual fund scheme. Now, what is the net asset value? Or basically, it's called, like how in shares you have what is called as a traded price. In the same way, in mutual funds, you have what is called as the net asset value. So all the value which is the combined value of the shares and the bonds and the securities which are held by the fund on any particular day in the given scheme. Okay, from that the expenses and charges are reduced, as a result of which the residual price which remains is considered as the net asset value per unit. Now, mutual funds are meant for whom? Ideally, mutual funds are meant for investors who do not have large sums of investment money, or who do not have the time or the research capability to do what is called as equity research, but they still want to grow their wealth. So mutual funds is one of the best way whereby they can, the money is collected in the mutual funds by the fund manager, and each scheme has its objective as to where they are going to invest the pool of money which is collected. Now, the fund house charges a small fees, which is deducted from the investment, and these fees are regulated by the regulatory body, which is known as the Securities and Exchange Board of India. They determine each fund is able to charge only a certain amount of fees for the schemes that are run by them. Now, to explain in brief, what are the types of mutual funds? You have what are called as open-ended schemes and close-ended schemes. So, open-ended schemes are those mutual funds where they are open once they are available for subscription. You can buy on any business day, similar to what is like you have your savings account. So you can deposit your money and withdraw any day in a savings account. The same way, in the mutual fund scheme also, you can buy on any day and sell on any day. So there is no maturity date, but you can enter anytime and you can exit when you wish to. In contrast to that, what is close-ended schemes? Close-ended mutual fund schemes are something like what you have as a fixed deposit, or something which is held for a fixed term. So the units of these closed-ended schemes can be subscribed when the scheme begins, but you have to hold them till maturity. The only difference is that some of these closed-ended funds are also listed on the stock exchange at times. So in case you want to exit, you can exit, but the person who buys those units will have to hold on till the tenure of the scheme. Now the classification of mutual funds. Okay, we have mutual funds in different categories, uh, which is there are funds which grow in which make your capital grow, which is called as capital appreciation. Then there are some funds which also do what is called as capital preservation. So thereby your capital is protected, and there will be a marginal increase in the profits as the scheme invest in the securities. The third type is what people look for as regular income. There are many people who would like to invest in mutual funds whereby they would get a regular cash flow. Hence the type of scheme as regular scheme. Then there are some funds which create liquidity for you. So maybe on a daily basis or a fortnightly basis, if you want liquidity, then these schemes are available. And the last type of schemes is what is called as tax saving schemes, which you can invest in for doing your tax saving under section 80C. Now the classification for these mutual funds is basically done by the underlying portfolio in which they invest. So there are two levels. The first level is decided on the asset class of funds which the mutual fund manager decides to invest in. Maybe it could be equity or debt or even money market instruments or gold as an asset class. So either the schemes could be a mixture of any of these three or any of these two or even four of these. Okay. The second level of categorization is based on the strategy which the fund manager uses to devise the portfolio. So it could be large cap stocks, it could be mid cap stocks, there could be small cap or even value funds or income funds or even dynamic bond funds. So going ahead, we'll come to know what are these types of schemes. Uh, Here, what we are trying to show you is the risk and return trade off by the mutual fund categories. So if you have towards the left of the screen where you see there is a riskometer, and towards the right you have what is called as the return category. So liquid funds by far they are the they are the least amount of they bear the least amount of risk. Okay, and as you go towards the top, then there are different categories which are known as ultra short term funds or even arbitrage funds. Towards the top of the category is what you have, which are called as equity-based funds or thematic funds. So when you invest, you must understand that what is the time frame you're trying to invest in, and what is the risk profile which is comfortable to you for the investment purposes. Now, these are some of the risk factors as defined by SEBI and the Association of Mutual Funds. These are some of the standard risk factors which you as an investor should bear in mind. That first and foremost, mutual fund schemes are not guaranteed or assured return products. The simple reason being that they are investing in securities where the price is fluctuating every day. Okay, so there is always something which involves investment risk, which depends on the trading volumes or even the settlement risk, and what is known as liquidity and default risk. So there is a possibility that there is a loss of principal also when you invest in mutual funds. Now, the third point is as the price, value, and the interest rates of the securities, which I explained, they keep on fluctuating. So the mutual fund value of your scheme may also keep on going up and down. Okay. Uh, so due to this, the NAV of the scheme, that is the price, will also fluctuate with the movements in the broader equity and the bond markets. By bond markets, I would say that they deal in the debt market, which is not compared to the or related to the equity markets. Okay, and these also could be affected by uh, uh, the factors such as the capital and the money markets in general, wherein you have changes in the interest rates or even the uh, currency rates. I'm so sorry. Uh, where you have changes in the currency rates or the interest rates or even changes in the government policies due to taxation or political factors as well. The last thing you need to understand is uh, the past performance of any scheme does not guarantee the future performance. So whenever you invest in mutual funds, what you must understand is that do not go only by the performance of the last first 1 year or 3 years performance, because each fund has its own characteristics, and they will perform in the in the period ahead. Now, what are the advantages of investing in mutual funds? By professional management, what we mean is that investors, they may not have the required knowledge or the time to invest in the market. So that's why they put this pool of money uh, to professional fund managers who will thereby do the research of the stocks and the bonds. Okay, and they will be able to buy and sell uh, on our behalf. Okay. By risk diversification, what we are trying to say here is that when you buy shares in mutual fund, you may come across categories such as equity, debt, and gold. This will help in spreading out the risk so that you don't have all eggs in one basket. By affordability and convenience, uh, usually people feel that when we have huge amounts we will invest, but in mutual funds the best way is that even small amounts as 500 or 1000 rupees a month, it gives you convenience to invest in mutual funds. Thereby you do not need to accumulate a lot of money to invest. Then we have the low cost factor. We have what is called as a liquidity factor, whereby, like I explained earlier, how you put money in your savings account and take it out. The same way, liquidity is a factor whereby in mutual funds, you can remove your money within a span of even 2 days or 3 days, and the money is available to you. Then you have what is called the low cost factor, whereby mutual funds, because of the economies of scale, the fund manager is able to deal in the stocks and securities at a very negligible cost. So that also helps out investors who are wanting to invest in the mutual fund. Okay. Uh, by well regulated, what we mean is that the fund managers and the fund houses which are set up, they are regulated by the Securities and the Exchange Board of India. Okay, so they have to follow the guidelines and the compliance issues for running the mutual funds. And then what you have is the tax benefits, which are investments in ELSS, which is equity linked saving schemes, whereby 1,50,000 qualifies for tax deduction under ATC. Now, these are the different categories of mutual funds, as you can see on the screen. There are almost 10 types of equity funds and almost 16 types of debt funds. Then there are hybrid funds and solution funds. So for each category, of investors, of any particular goal which you have in mind, there are separate funds whereby you can, invest in the particular category. So to explain it more in detail, these are the five broad classifications, that why one should invest in equity. You should come to equity if you have an outlook of 3 or 5 years or more, because equity tends to fluctuate in the near term, but over a longer period of time, you get the benefit to create wealth. Then there are what is called as debt funds, which I said, which deal in the bond markets. So there are treasury bills, there are CDs, which are called as certificate of deposits. There are commercial papers which are issued by corporate houses, and there are special licenses. So as retail investors, we cannot deal in them. So any investment which you want to do between 1 to 3 years. So typically investors like to invest in a bank FD because you are not aware that there is something which is called as debt funds. But your bank in turn puts your money or fixed deposits into these treasury bills, and so what is called as certificate of deposits and CPs. Then you have what is called as the hybrid category, which invest in stocks as well as fixed income as well as gold. So the time frame for a hybrid fund should be anywhere between 3 to 5 years if you are looking at a very as a very safe instrument, or where you don't want too much of volatility. So people can opt for hybrid instruments. The other category is the liquid funds, where again, like how you put your money in your savings account, any time frame between 1 to 60 days or even 1 to 80 days, you can invest in what is called as liquid funds. Okay, so liquid funds do not have any correlation to the equity market, but liquid funds invest in these government securities and treasury bills. And the last category is the ELSS schemes, which I just explained that you can do for tax savings. But however, the scheme is locked, the units are locked in for 3 years. Now, mutual funds offer, multiple product choices to us. So you may want to invest in equity, debt, gold. Now, this would be based on, the time frame of each individual's goals. Maybe he wants to invest for his child's education, who is just maybe 1 or 2 years, or even just born child. Maybe he wants to, they want to save for their children's marriage. Maybe their sons or daughters' marriages, 10 years, 15 years down the line. Maybe somebody wants to look at his house purchase, and somebody maybe want to look at his retirement expenses. So all these goals can be achieved via mutual funds. So which is why mutual funds offer a lot of schemes, and they cater to each type of individual investors need. Now the only thing that can be challenging is which fund to choose, and what you should be taking into consideration, what I explained by what is called as the risk return chart. Okay, and what should be the time horizon? So my suggestion to all of you would be that you need to consult either a professional mutual fund distributor or a registered investment advisor who will help you out go through these schemes as to which scheme would suit you best. Okay, now there is always, of course, a choice that, like how we deal in shares, investors will always want to, invest in the securities market on their own. But mutual fund is such a product that all these benefits come to you in a single package. So here, what I just explained in the earlier slide, that, to save money for your family's financial goals, which could be, your children's marriage or higher education or even your own retirement, many people choose to save money in fixed deposits or other savings instrument, but these offer very less returns because an investment with a good return will obviously secure your future financially. Okay. Now, only thing you need to know is that you should invest in the right asset class to ensure the security of your family's future. Now, to achieve these goals, the main hurdle which we have here is what is the inflation factor, the biggest, the hurdle to achieve our goals. Now, as you can see, as per RBI's estimates, the wholesale price inflation index, it has been, generally 6.5% over the last 30 years. So what was the price of gold in 1990 at 3,200 is almost at 49,200 in 2022. So ideally, the actual inflation is 9.2% if you go by the price difference. Petrol, which was at 9.84, in 1990, that is costing us over 100 rupees now, 105 rupees. Same goes for diesel, which was 4 rupees a liter in 1990. In 2003, it is 21, and in 2022, it is at 97. So which inflation is almost 10%. And what is the price of milk, our basic commodity for our daily use? The price of milk in 1990 was 6 rupees, which has increased to 13 rupees in 2003, and almost at in 2022 it's almost at 70 rupees now, which is an inflation of 8.2%. So what we are trying to tell you is that inflation is going to reduce your purchasing power. So if you take a 7% inflation in 1990, if someone had 1 lakh rupees, the value is almost 10,000 rupees in the year 2022. So you need to plan your goals in such a way that along with inflation, you need to have substantial amount of money at the future date. So let's say today somebody's household expenses in 2012 was 20,000. The same household will require nothing less than 37,500 in today's times, and in 2032 it will shoot up to almost 70,500. This is assuming 6.5% inflation. Now same goes for higher education. Somebody who was paying say 6 lakhs in 2012, in 2022 it's almost costing 11.25 lakhs. In 2032 it's going to cost you 21 lakhs. So whatever goals you have in mind, for graduation or post graduation, please bear in mind the cost of inflation for achieving these goals. And lastly, of course, the marriage cost. If a family is spending roughly around 8 to 10 lakhs in 2012, in 2022, nothing less than 15 to 18 lakhs is required to have a good wedding, a wedding occasion. In 2032, it will be nothing less than 30-35 lakhs uh, for that same function. So how do you achieve these goals, and what is the right asset class? So what we are trying to tell you is that we are not against any of the other asset classes. Okay, the only thing we are trying to portray here is that if inflation is at roughly 6%, between over the period, gold has given you almost 8.66%, whereas inflation is at around 2.56. So you can see the difference. What is the real gain achieved by the individual. Same way goes for silver, bank deposits, and company deposits. But if you see in mutual funds or even in equity class, equity as a asset class, your actual gains are 15%, whereas the real gain is only 8.55, because almost 6% is your inflation factor. So if somebody had kept 10,100, or rather had he invested 1,000 in these asset classes, due to inflation, it would have grown to only 10,000. Okay, in today's terms, whereas in gold it would be 27,000, in silver it would be 24,730, in a bank FD it would have only grown to 24,940, whereas in equity mutual funds it would have grown to almost 2,69,000. So this is the growth from the period 1982 to March 22. So as you can see, equity is the asset class where you will be able to make money over the long term, and it's the process is also very transparent. It's very convenient also. Now, how do we invest in equities when somebody wants to go via the mutual fund route? So I will just just give me a minute. I will take a pointer just to try to show you. Okay, so here what we are trying to tell you, if somebody wants to invest in the mutual funds via the method which we are saying presenting here, if somebody wants to invest 1,000 rupees in a scheme, and if the NAV, the net asset value, is 10 rupees in the first month, the investor will get 100 units. In the second month, the NAV is 8 rupees. So for the same 1,000 rupees, the investor gets 125 units. Okay. In the third month, the NAV of the unit is 9 rupees. For the same 1,000 rupees, the investor gets 111.11 units. And in the fourth month, when the price of the NAV is 11 rupees, for the same 100 rupees, the investor gets 90 units. So what do we see from here? If you add up the units, the total comes to 427.02 units. Okay. So if you divide 4,000 rupees by 427, you will get what is called the average price per unit. So the advantage here is that when you invest via mutual funds, you capture the volatility in the market, because when the price fell down from 10 to 8 rupees, the investor got 25 units more. And when it rose, he got less units, 10 units less. So the idea is that when you invest via mutual funds, the main thing which you need to target over the first 5, 6, 7 years is what is your average cost per unit. The more the number of units, the better will be your profitability, because suppose in the fifth month, if the investor were to sell and the price is only 11 rupees, so for the 4,000 rupees which he invested, if you multiply 427 by 11, you will get 4697 4,697 rupees. So thereby you get a profit of 297. As compared to that, there is another person or investor who invests only one time. Okay, so his unit in the inception stage, he bought 400 units at 10 rupees. So his investment of 4,000. Today, if he goes to sell at 11 rupees, his market value is 4,400. So what you need to see here is that When you buy in SIP mode, you will get more units when the market is down, and when the market is up, you'll get less units. However, as a one-time investor, you will have to wait for the market to give you that sort of return. Now, if you see the Sensex returns, when the stock market started in 1979, at that time the base price was 100. And if somebody had invested 1 lakh rupees at that time, today in 2022, the Sensex is somewhere in the range of 58,500. So your value, if you had left the 1 lakh at that as is, it would have become almost 5.85 crores in the last 43 years, which is a return of 15.96 CAGR, which is compounded annual growth rate. So how do we explain that, why this money has grown so much? The simple reason being the due to the power of compounding. So Albert Einstein has said, the one who understands the power of compounding will definitely make wealth, because if 100 rupees were kept and if 15% was the rate of compounding, in 5 years that 100 rupees will become 200. After 10 years, it will become 400. After 15 years, it will become 800. And after 30 years, it will become 6,400. So you need to give time to the money to compound. Now, to explain, how you can invest in mutual funds, the simplest way is what is called as SIP, which is systematic investment plan. Okay, and it is also known as very simple, intelligent, and practical. Now, SIP is a way of investing in mutual funds whereby a fixed amount goes into the mutual fund schemes every month. It is similar to how you invest in a bank fixed deposit or a post office RD. Okay, and it's a very easy and transparent way to invest your money. For that, what you need to do is you need to sit with your mutual fund distributor or registered investment advisor. You need to tell him that which is the fund which you need to select and what is your outlook of the period of investment. Then you need to select a date whereby every month that fixed amount will get deducted from your bank account, and it will it will get invested as per the NAV of that date. Now, many people think, that when we get a huge amount of money, we will invest at that time. But ideally, it's a myth. Basically, you can do small amounts of investment every month. Like I said, a minimum amount of 500 or 1,000 rupees, which will help you build wealth over the long term, and it will also help you towards the benefit of compounding your wealth. So, what are the benefits of SIP? To explain in brief, the first thing is that it helps you to become financially disciplined. Every month a fixed amount will go, which will make you aware that you're going to invest this money towards your investment goal. Okay, irrespective of your whatever the market conditions are, the regular investment will go on that specific date. Okay, like how I explained in the earlier slide, the cost of averaging, rupee cost averaging helps you neutralize the market volatility. Okay, and the benefit, the last benefit is the power of compounding. So like we say, every drop of water is essential to make a mighty ocean. So the same way, every rupee saved helps you to secure your future. Now, many people ask us, why should you invest in SIP for the long term? So as seen in the earlier slides, in 1979 when the Sensex was 100, and in 2022 it's at 58,569. So it has grown to almost 16% compounded annual growth rate. So over a long period of time, as you can see in this chart on the bottom of the screen where it's written volatile markets, in the short term the market will appear very volatile. It will appear like a roller coaster, but towards a longer time frame of 10 years, 12 years plus, the price will always be rising, whereby you'll be able to make substantial amount of wealth. To explain or give an illustration, which is shown here, an SIP of 10,000 rupees per month So the 20-year performance, your 24 lakhs has become almost 1.71 crores. So which has grown to almost 17% compounded annually. Now, this is taken from a research of almost 30 schemes over the period of 20 years. Many people ask, okay, in which scheme should I start my SIP? So basically, it all again boils down to, what is your risk appetite? And you need to sit with your distributor and you need to tell him what is your tenure. And based on your risk appetite, he will suggest what are called as large cap funds, mid cap funds. These are basically decided on the market capitalization of the stock. So large cap funds are very less volatile. You have something like what is the Tata Motors or the Tata Steel. These are large cap stocks, like Infosys, where the volatility is very less. But there are some stocks which are mid cap stocks or even small cap, where they tend to go up faster with the markets, and they tend to fall a little faster also. But these mid cap and small cap stocks, over a period of time, due to the market capitalization, may touch even the large cap category. So you must always invest in a bouquet of funds, thereby to diversify your risk. Now many people ask us, whether we should do uh, uh, whether we can do SIP in gold funds, or how do we invest in golds. So gold funds are also another option available, whereby you can invest in mutual funds via the mutual fund route through what is called as gold ETFs, which is exchange traded funds. So the fund manager invests in gold. Okay, he takes the money, invests in gold, and the price of the gold is relevant to the price of the physical gold in the market. So the advantages here is that you don't have to worry about the storage issue. There is no uh, there is no two ways about even the quality of the gold which you are taking, because it's in electronic form, and you can redeem this gold at any time whenever you want to buy the physical gold in the market for your wedding functions or any occasions which you want to give as a gift. However, gold in the long term, what we have observed is that it gives return equal to inflation. Maybe in 1 year or 2 years, you may find that gold has given you a 10 or 12% or 14% return, but over a longer period, it is just given you returns equal to inflation. So many people consider gold as a hedge towards inflation. Now, when you invest in SIP, what you need to know is that you need to stick to your SIP for a longer period. You cannot come to the mutual fund segment and invest in SIPs only for a short term of say maybe 1 year or 2 years in equity funds. For equity funds, you must always have a long term view. Now let's take an example here, a live example, which is a tech fund which was launched in March 2000. Okay, at the NAV of 10 rupees. Over the over the next 20 months, the NAV fell from 10 rupees to almost 2 rupees. That means it was almost an 80% fall. So your 2 lakhs investment has almost become almost 99,000. And what happened over the next 2 or 3 years? The same SIP which was continued by the investor, the 3 lakh value of investment or 4 lakhs, is just languishing there only. There's still a 10% drop in the value. Now, for the NAV to come back to 10 rupees, it takes another 3 years. Okay. And if you see, in the next 3 years, when the NAV came back to 10 rupees after falling to almost 2 rupees, the CAGR has touched to almost 30%. Why? Because the value of your investment, which is 7 lakhs, because you've continued the SIP, that value has grown to 17 lakhs now. So how did this happen? This happened like when I showed you earlier, that you buy more units when the market is down, and you will buy less units when the market is up. So as a result, when you bought more units when the market was at 2 rupees, those units have increase your investment value. Okay, and whereby 26.50 lakhs has almost become 4.8 crores, and the NAV is at around 162. So which gives you a return of almost 21% if the investment was continued till 31st March. Now we have some basic questions where investors tell that, whether we can change our date in SIP or can you increase the SIP amount. So to answer that, yes, you can change your date in a SIP. Okay, and you will have to first stop the SIP and restart the SIP. Okay, most of the time we have online platforms where this can be done in a few minutes, so it does not involve any paperwork. But anybody who's doing in the physical format, they can obviously give the necessary request and the SIP dates can be changed. And even the SIP amount can be increased. Now, there is another factor which is there that, many people ask that, is my money locked in SIPs? Now, there is one thing which you need to note as an investor is there is no lock-in in SIP except for ELSS funds, which are locked in for tax saving for 36 months. The flexibility is very high in systematic investment plans. Okay, you can stop the SIP anytime you want. You can redeem it anytime you want. And unlike, like say, an insurance product, there is no concept of surrender value out here. The day you decide to redeem your units, whatever is the market value of the NAV at that time, you will get the value of your units. At times, people also ask us, is there any TDS on SIP? So let me tell you, there is no concept of TDS on SIPs or equity mutual fund investments. There is, however, what is called as a STT, securities transaction tax, which, as you can see on the screen, it's almost rupees 25 for 1 lakh of redemption. And there is also, from the last 2 years, what is called as a stamp duty charge, which is levied. So on a 1,000 rupee SIP, there's only a 5 paisa charge. So on a 1 lakh, almost 5 rupees is the stamp duty charges. Now coming to the taxation part, uh, STCG stands for short-term capital gains and LTCG stands for long-term capital gains for those who are not aware of the terms. Okay, short-term capital gains for short-term basically tenure refers to anything which is held in less than 12 months, and long-term is the value of the tenure of the units which are more than 12 months. So you need to know that short-term capital gain tax is 15% of your gains which is there, and long-term capital gains are exempt till 1 lakh, and above that you are charged a 10% value. So suppose your investment value was 1 lakh and you have made a profit of another 1 lakh. Okay, so based on the long-term capital gain factor, if you held those units for more than 12 months, then the next 1 lakh capital gain is tax free. However, if that 1 lakh is 2 lakh 50,000, so then 1 lakh, the breakup is that from the 2 lakh 50,000, the first 1 lakh is your capital, the second 1 lakh is your capital gain, which is also exempt. On the remaining 50,000, you will be paying a 10% tax, which amounts to 5,000. So many people ask after seeing, these presentations, and when they hear their friends or their family members saying that, no, you must start your SIP journey. So the ideal time for investment is as soon as you get your first check from your job. That is the best time to start investing, because you will start getting the benefit of compounding the earlier you invest. Now, many people say, yes, I will start from next month as soon as my salary comes. But what we have observed over the period of time, that, when they say next month, that next month staggers away to 2 months, 3 months, 4 months. Eventually, what happens is a whole year passes by. Now, if someone were to invest for a SIP for in SIP for 10 years, okay, but he has already spent a 1 year deciding that he'll start next month. So you can see here what is the delay cost coming to the investor. If he's doing a 10,000 rupees per month SIP, in 9 years his investment value of 10 lakh 80 has grown to 22.45 lakhs. Whereas the person who does it for full 10 years, his 12 lakhs has grown to 27.5 lakhs. Thereby, the delay cost to the first person is almost of 5.06 lakhs. And over a 20-year time frame, when you delay the investment by over 12 months. So here you can see the delay cost in a 20-year time frame, when the money is growing by 16%, you tend to lose out almost what is 40 lakhs, which is not a small sum of money. Now, coming to the question of how I can increase my SIP, okay, every year. So the best and the easiest way is what is called as a top-up SIP, which is available now in all mutual funds. The only thing that one needs to understand is that you need to start the top-up SIP at the time when you're registering the SIP. So as you know that if your salaries are going to increase by every year by say 5% or 7%, then what you can do is you can increase your SIP. So for the first year, every month 10,000 rupees will go. But if you increase it by 1,000 rupees uh, every month for the subsequent years, so the second year it will be 11,000 every month. The third year it will be 12,000 rupees every month for the next 12 months. That way, when you increase your SIP, so over a period of 30 years, instead of 3.8 crores, which one would have got by a normal way of SIP, you will accumulate a corpus of 5.33 crores. So how does this help you? This helps you to build wealth faster. Along with your rising incomes, you don't need to worry as to where to put the money in, and it automatically helps you to increase your savings. It helps you to beat inflation, and of course, you can reach your financial goals faster. The next question would be, when should you redeem your money? Ideally, if you were to ask me, if you're doing SIP, you must align it to a specific goal so that you exactly know when to redeem the money from that specific scheme. Okay. And what you can do, the best way to do is, as equity markets are volatile, if your goal is slated for say for the year 2030, the best way to do is move the equity funds from equity to debt by the year 2028. So at least the last 2 years you won't have to face volatility. But we always would say that please do not try to do things on your own. It would be better if you consult your mutual fund distributor. Now, this question out here, you have stopped your SIP. What should you do now? Many people, when markets are up, they immediately stop their SIPs, thinking that they can time the market. But the the point here to note is that markets are something which are very volatile and they're very unpredictable. Markets in the year 2000, March 2020, when COVID started, okay, and by September 2020, the markets had just jumped back sharply, and there are many investors, who did not get a chance to get back in. So the best way to is continue your SIPs irrespective of whatever the market situation. Then many people would say that, okay, now in September 20, when the markets are high, should I start my SIP? We would say yes, please invest in SIPs irrespective whether the market is high or low, because like as seen in the earlier slide, markets are going to be volatile. But what was the Sensex 10-15 years back at 5,000 or 6,000? The Sensex has grown much more, by leaps and bounds as what it is today at 58,000. So do not try to time the market. India is having a very long term growth story, and we would say the earlier you do your SIP, the better it is. Now, these are some standard disclaimers which we as a mutual fund distributor need to disclose to you, that we cannot randomly recommend any scheme names, but whatever we've tried to present to you is the best manner possible, available on the data at hand. And we can now open up the session for question and answers and your feedbacks. Thank you. Riddhi, you can take over now. Riddhi? Yeah, I think you're on mute. Riddhi, I think you're on mute.
Yes, sorry.
Ah,
I think there was some network issue.
okay, no problem.
Okay, so you can please continue. Sorry about that.
Yeah, no, I said I've just opened up the session for Q&A, so we can
Okay,
take
perfect.
any Qs. Yeah.
Perfect. So I think we've got few questions in the Q&A box and in the chat box. I'll read them to you.
Sure.
and you can answer. So somebody's written, which is the best date of the month to start SIP?
Any month.
No,
This
I
month
think
is,
the date of the month.
yes. Any date is good. Okay, over a 20-year time frame, there
Hmm.
are various charts which are shown. So any date is the best date to start SIPs. There is absolutely what do you say 0.1% difference whether you start on the 10th or 12th of the month. It is absolutely uh, no difference to your investment or market value.
All right, awesome. Next is, what should be minimum amount to start SIP?
See, mutual funds SIPs, they start as low as 500 or 1000 rupees. So based on the investor's convenience, he can do with 500 or 1000 depending on what the fund house has laid the minimum criteria for the each individual scheme.
Okay. All right. Next question we have here is, how should one invest now? Has the Adani fiasco taken a toll on investments made for long term?
I was hoping that this would have been the first question out of the
Q&A
yes,
session.
yes. So let me tell you. See, there are 6,000, more than 6,000 companies listed on the Bombay Stock Exchange. No doubt, the corporate name has been going around since the last few days. Okay, but one must tend to understand that even the regulators, that is RBI, the State Bank of India, which is the largest bank in the country, and as far as the LIC is concerned, the largest investor in the country, all have given their statements that they are well within the limits. And irrespective, if somebody was directly in the equity market, I would say he should study the balance sheet and understand what are the pros and cons of the Adani companies, which are diversified into all this thing. The advantage here is, if you are doing via mutual fund route, the fund manager is the best guy. If somebody actually takes down the data from the mutual fund website,
Again,
there,
this seems
there are very few mutual funds
to
who have
be some of the show.
you can hear me.
Yeah, better now.
Yeah. So I'm saying the advantage of investing via the mutual fund route is that the mutual fund managers uh, take the onus on themselves to invest in such companies, and if they are investing, they would be the first ones to get out of the schemes if required. Secondly, via the mutual funds, there is a regulation and a limit laid down by the SEBI and the Association of Mutual Funds, that based on the corpus which the fund manager is managing, not more than 5 or 10% of the corpus can be invested in a particular scheme. So if you are managing 10,000 crores in a mutual fund, a 5% exposure to a Adani company is what is the maximum which can be taken by the fund manager. So as such, you are shielded from all these factors when you go via the mutual fund route. So,
Okay.
so to answer the query is, irrespective whatever happens with the Adani fiasco, if you're going by the mutual fund route, even if the fund house is making a loss in Adani, he will try to make it up in some other companies if he wants to sell it. But the fund manager is in a better position to judge whether he wants to make a loss or profit, which
Okay.
eventually is going to benefit the in all the investors in the scheme.
Okay. Great. Thank you for that answer.
Yeah, yeah.
Next question we have here is, which mutual fund is best for short-term investment?
Yeah. So like I said, you have categories of debt funds also. So any time frame between 1 to 6 months or 1 to 3 years, there are short-term debt funds which will cater to your need to meet that goal. So debt funds do not have exposure to the equity market. They invest in what is called as treasury bonds.
Okay. All right. So we've answered your question there.
Yeah.
Any examples of low risk and high yield funds?
You can say debt funds are something where the risk is low. Okay, and high yield funds would be thematic funds where you invest in a particular sector. Maybe you can invest in pharma sector or the IT sector or infrastructure sector. And many people try to time the market thinking that they know that this sector is going to do well, but post COVID, it is not necessary that pharma will do well. So if you take an exposure in the thematic funds, there the risk will be more.
Okay.
Yeah, but it's like high risk, high return. So if you're willing to take that risk, then definitely you will get high returns. But your gestation, rather your gestation period or the holding period will have to be slightly longer based on the cycles
Okay.
of that sector.
Okay. Get it. Next question we have here is, are mutual funds considered as risky investments?
The SEBI tagline says that mutual funds are subject to market risk. I would tend to say that the mutual funds are subject to volatility. Uh, as over the years you have seen, mutual funds are not risky, but the standard disclaimers obviously they do say they are risky. But so what you need to understand is the if you are not able to bear the volatility, invest in debt funds or invest in what are hybrid funds, where the fund manager tends to bring down the volatility for you, and thereby it will be a safe investment to grow wealth, because ultimately they are investing in the stock market, and stock market are the companies where just now where we are using Zoom, where we are using Power, where we are wearing the clothes. All that is either by Reliance or Aditya Birla or Tata Power. Even the net we are using is by Jio or Airtel. So if all these companies are running and the stocks are listed, the price is going to fluctuate.
Okay.
Yeah.
Okay. Next question we have here is, I have investments in FD saved for my daughter's marriage. Should I invest that amount in mutual funds?
Uh, Based on the time frame when the daughter's marriage is about to take place, I would say you do not need to shift all. However, based on your risk appetite, you sit with your mutual fund distributor or your advisor and see how much of that portion you can invest in mutual funds. Uh, let's say in hybrid funds or equity funds based on your risk appetite.
Okay.
But I would not like to say that you go all in, because at the time of marriage, if the market is down, you should not blame the market or the distributor or the advisor, and you can't blame luck definitely.
Correct.
Yeah.
Makes sense. Okay, so somebody's asking a question. What app would you recommend for beginners such as Grow, Zerodha, etc.?
Okay, this is also expected answer. See, these apps are what are called as robo advisors, and they tend to pick up the performances of the last 1 year, 3 years, 5 years, and that is how they recommend the schemes to you. But those schemes which are maybe uh, comfortable to you may not be comfortable to me, because my requirements would be different. So it is always better to sit with somebody who's able to understand your requirements, and then invest in those schemes. You may choose your Grow, Zerodha app or whatever, but we have seen that over the time, there's nobody to where you can speak uh, to a human being. If you're going to speak to a app only and do it, maybe you may make money in the first 1 to 3 years, but over the period of time, who's going to observe whether that fund is good, whether there have been changes in the scheme, whether the fund manager has changed, you know how frequently is the fund manager churning the portfolio, so whether that is comfortable to your risk appetite. So these apps are available, but you need to take the call at your end, whether you want to take advice or whether you want to go at the app.
Okay,
Yeah, these
great.
apps are all there available. So
Right. Okay. Next we have here is small cap versus large cap, which is better? I have invested in small cap currently.
both are good based on your tenure of investment and what is your risk appetite. Large caps are fluctuating very less. Small caps will move faster with the market, and when the market falls, they'll fall more. But like I said, higher risk, higher return. So you must distribute between large cap, mid cap, small cap based on your specific goal and the time frame which you want to invest for.
All right.
It's not a very diplomatic answer, but the idea is to spread out your investments so that you don't get skewed towards one particular sector.
Got it.
Yeah.
All right. Next question we have here is, if we have not adopted for any top
Top
up
up as
SIP
initially.
initially, how can be updated our existing SIP for same?
Now, there are two ways. To answer the first one is that you can either stop the current SIP and then start the fresh SIP with a top up mechanism. Else, what you can do is, if the fund house has, say, if your scheme is running for 1,000 rupees and you want to top it up by another 1,000, you start a fresh SIP on another date.
Okay.
So that A, it becomes easier for you you know which SIP was started later on, and if you, in case you want to stop any of the SIPs, you know exactly which SIP to stop. By putting
Hmm.
both on the same date, you will not get the benefit of the rates in the market. Okay, you won't be able to factor in the volatility because market
Right,
is not the same on every 2 days, and you won't know which SIP to stop if you do on the same date.
right. Okay. Next question we have is, do normal mutual funds help you save tax other than ELSS funds?
No, normal mutual funds don't help you save tax. Rather, they help you make wealth.
Right. Okay. Somebody's asking, will you, Mr. Nimish, help or guide in investment? So yes,
Yeah,
definitely.
as a mutual fund distributor, yeah, I can guide you based on your risk appetite whether you want to go in for large cap, small cap, mid cap. We cannot recommend direct schemes as per the SEBI mutual fund rules. However, we can give you the choice of schemes in that particular segment, and then you can choose.
Right.
We will of course give you what are the performances of the schemes. Then it's up to you, you know, how you can choose. But
Perfect.
we will not be biased towards any particular fund house or scheme.
Got it. So, Mr. Akshay, we have put Mr. Nimish's number in the chat box for everyone to see, along with a feedback form link also. So you can, give in your feedback there also about the session. If you have any questions, you can definitely reach out to Mr. Nimish. Anybody can reach out to him for any questions. Okay, I think we've got few questions in the
Chat
chat
box.
box as well.
Yeah.
How soon should we change our mutual fund? Currently, my mutual fund is in loss.
Yeah, like I said, you know, I showed the typically that tech fund. So you need to evaluate when you started the fund how the fund is doing. Somebody, you have to sit with somebody to help you guide you, you know. But don't panic in just what do you say, 1 year or 2 years and just stop your mutual fund just because there is a loss.
Right.
So yeah, there are 1 2 clips I wanted to show, you know, that they would have seen the mutual fund campaign where it says, you know, that you need to have patience in mutual funds. Just because you started investments and in 6 months your investment value is down, you should not get worried, you know. Just give time for the fund. But for this, Mr. Karan, I can definitely say, if you sit with your distributor or if you need a one time suggestion, maybe we can have a look at it and then, you know, take a call.
Right. Okay. I think, Mr. Karan, your question is answered now. Next question we have here is, for an absolute beginner, how can one get started in SIP? How much amount should one start with?
Ideally, it again depends. You can start with something as low as 1,000 rupees, 500,000, 2,000, whatever is your comfort level. And the best way to get started with SIP is either you, if you want to go directly, you can go via these apps, or you can tie up with any one of us mutual fund distributors. We will be more than happy to guide you.
Got it.
Yeah.
Okay. Next question we have here is, suggest one best mutual fund for long term as per your knowledge.
Like I said, we can't be biased on any schemes, but mutual funds, there are categories in long term, what do you say, in large cap and mid caps, where the funds have been performing. So there has been, if you say, there was a corporate fund house where the very name of that director was not taken in very good stead, you know, when he broke off from the big corporate house, and eventually that fund house was taken over by a Japanese corporate body, and that fund is still going strong. So in 1995, the NAV of that fund, that scheme was 10 rupees. Today it is over 2,000 rupees the NAV. So you can imagine the number of times the money has grown. So, you know, you can calculate that if you had put 10 rupees as maybe a 1,000 rupee investment or a 10,000 rupee investment, you would be sitting on nothing less than 17, 18 crores today, because the NAV is at 2,000.
That's awesome.
Yeah. So this is just one suggestion. I think from what I spoke, if somebody is smart enough, they can understand what fund house I'm referring to.
Right. Okay. Can there be any guidance on which fund to invest? How to choose your investor who will be a mentor to guide us?
Yeah, sure. If somebody wants to come through me, then you can definitely, we can guide you out, or
Yes.
you can, you know.
Yes. So, Miss Kritika, I think I would suggest you get in touch with Mr. Nimish. So he's a certified distributor for financial products. So he would be a good mentor and guide to, take your investments forward. If that's what you also think, then you can definitely get in touch with him. We've put in his number there. Okay, another question we have here is what factors to consider while choosing mutual fund?
Yeah, so as I explained earlier, you need to understand what is your risk appetite. B, what is your tenure for which you need to, the goal time frame which you have in mind. Okay, and the third factor would be that you need to diversify between the large cap, mid cap, small cap, so that you're not you get the best of all the three segments.
Right.
By way of market capitalization. So the small cap companies would be tomorrow's Infosys. So you should invest in those sort of companies as well.
Okay.
So
All right. I think
yeah.
that's the end of our Q&A. If anybody has any questions, please put in the box right now. Otherwise, you can always get in touch with Mr. Nimish. We've put in his number. One thing I would request all of you is that we've also put in a form link here. Please request you all to fill up that form. It helps us understand the kind of sessions that we're doing and specifically feedback for this session. So we understand that what kind of financial sessions you guys would want to hear and attend in the future. So please, the form link is there in the chat. Please do fill it up now or later. You can just copy paste this link.
I would just like to add, Riddhi, that if anybody who comes through me, or maybe when they fill in the feedback form, when they give the email ID, what I tend to do is I don't call up anybody immediately. Okay, only even if the mobile numbers are mentioned, I don't tend to call up anybody. By way of email, what will happen is they will receive my monthly newsletters. Okay,
right.
And me being associated with two national distributors, we conduct webinars every fortnight where fund managers come and give you guidance on what are their schemes and how how the investor can keep growing his wealth, and what are the different ways, and the question and answers which are there will throw some more light to these investors.
Right. Great.
So maybe these young investors who are there,
right.
or the young participants who are there, maybe even for their family members, these webinars would be beneficial, because those webinars are conducted by us free of cost. You don't have to pay anything. You can see from your mobile, your laptop, your desktop, so the convenience of from your home. Thanks to Zoom, we organize this fortnightly, so it would be beneficial to them. We'll answer more of their queries.
Awesome. Thank you so much for clarifying that your numbers and everything that you put on the form will not be spammed.
Yeah.
So yes, please trust us on that. We will not be spamming you, but just a general information would be shared with you in case you're looking for webinars, and you can always unsubscribe even after you've subscribed once. So please do fill up the form. Get in touch with Mr. Nimish, and thank you so much for attending our event today. Looking forward to having you guys attend our future events as well. And a big thank you to Mr. Nimish for being kind enough for conducting a session again for us and taking out the time for this session and, answering all of our queries. Thank you so much.
Thanks to all the participants for spending their time. Thank you.
Thank you. Have a great day, everyone. Have a good evening. Bye.
Thank you.